here for investment lineup update. One thing that you'll notice across the board in our models, we really have been increasing our what I would call alternative asset classes, especially with gold, and then just last month in August went into some silver. We started that position at the end of 2018 with GLD, GDX for ETF portfolios, and then a couple of miners, specifically Barrick and Newmont, for the stock-only portfolios, and those have all performed very, very well. We went into silver last month with SLV. Historically, there's a pretty good ratio between gold and silver prices that it got out of whack, and silver's outperformed in the near term. So that's one component you'll notice. Another component is we are added to our REIT space back in late April and early May. This is because we thought rates would continue to trend down. We went into Medical Properties Trust, MPW, in a lot of our portfolios. That's turned out to be a pretty good place to be. We continually own BXMT, but we are watching it as the chart on that has weakened in the last 90 days, and it's a big holding in all of our models, and so that's one we are very much watching. But it has the lowest debt load we can find in the REIT space, and so we're keeping it for the time being. Other, what I would say, themes you will notice, one is water. AWK hit a real big all-time high just about a week ago. It's off that. We've went into Xylem, and then also Advanced Drainage System, WMS. I would say don't go to sleep on a lot of the perceived agricultural products. WMS does drain tile, field tiling for farms. I think Wall Street thinks only when commodity prices are rallying do farmers tile their fields. But in reality, with all the rain that happened in the upper Midwest, it's become paramount that farmers continue to tile their fields, and that stock has responded very, very well for us. We picked that up, I think, in May, and have had a double-digit increase in that since that time. Things that we're watching. A long-time stalwart in a lot of our models on the individual stock side is Altria Group, symbol MO. They can't get out of their own way. Of course, they're famous for the old Marlboro Man puffing on some filtered cigarettes, but they tried to diversify into wine, cannabis, otherwise known as the weed for those D2 clients on the West Coast, and also into some of this vaping stuff, and they kind of continue to go from the frying pan to the fire. They had a huge surge on their announcement they were going to re-merge with Philip Morris International, but that has since waned, so we're watching that. Also, we're taking the run-up in AT&T as an opportunity maybe to exit that stock given the huge debt levels. AT&T has more debt than I think most countries, including European states. So they spent a lot of money getting into DirecTV, only to find 3 years later you can live stream most anything you want into your house under the auspices of the internet. So that's a couple positions we've been trimming down. You'll notice that. Where are we going? We continue to get a little bit safer as the years go on, especially as we go into the fourth year of a presidential term cycle next year. We've had a pretty good double-digit run-up in every model we have, so we want to take profits while we have them and make hay while the sun is shining. You'll notice on the fixed income side we are short, high quality. That would lead you to believe we don't think these super low rates are going to be locked in place. We think there'll be more rate volatility, and we want to use our fixed income piece of the portfolio more as a keel of the ship, and we can generate income from other alternative spaces such as REITs, some of the private equity companies like Blackstone that we have, or Icon Enterprises, Macquarie, etc., to generate higher income for clients. And as I said in the earlier segment, don't fall asleep on healthcare. We have been really underweight healthcare, with the exception of a Fidelity Fund and some J&J, a little bit of Amgen. That will change as it looks like we may get into election silly season, and if anything becomes a real screaming buy, you'll see us add that to our models as well. And in the Vanguard model, we had been taking profits all through last year in healthcare. We underweighted it, and we'll probably start buying more, I would say, as the year as the election starts beginning of next year. Until next time, we'll talk about this more in February. Have a great fall. It's the most wonderful time of the year. You've got baseball, football, kids' sports are winding down, hopefully, if you've got young kids. And Thanksgiving's right around the corner. So until then, gobble gobble. Good afternoon, Dynamic Directions. This is Drew Watson here with the September market update. Well, if you made it through August and the rest of the summer, you know we had volatility return and then some as the trade talks broke down once or twice, resumed once or twice. Fears that the retail sector was doomed, but then Walmart and Dollar General and Target proved that those fears were unfounded. All the while, gold and silver rallied tremendously while this volatility returned. So in looking at markets and where we stand at the beginning of September, we've had rates come off the floors that they hit in August, and I think many rates, 10-year Treasury, 30-year Treasury specifically, hit all-time lows on their indexes. These were lower than they had been in 16, and it indicates that the Fed is under pressure from the bond market to lower rates as much as possible. We'll see how low they go later this month, but it's clear the trajectory for short-term interest rates will soon follow the trajectory that longer-term interest rates have been on for the better part of a year. So where does that leave us? Your bond portions of the portfolios that you manage should have lots of profits. I've seen gains anywhere between 4 to 14 or 17, 20% on different pieces of fixed income given how rates have collapsed. One thing that may be prudent is to evaluate whether or not you want to take profits, especially in longer dated paper, as rates have risen back, and it could be that a snapback rally in rates might be on the offing. Secondarily, but very much under the radar, has been oil prices. Black gold typically takes the precedence on all the commodity reporting, but gold and silver had such a strong move in the last 3 months, and really year to date. Gold had oil had kind of fallen off the front page of the paper. Very quietly, as of today, West Texas crude's back to about $58 a barrel, which is as high as that's been in a while. While we've had gold sell off, we were in the upper 1500s an ounce, and as of just right now, we're just under 1500 by a few cents an ounce. What does this mean? It means typically that portion of alternatives in your client's investment sleeve that had languished with not much returns for the last few years has been a relatively bright spot for client portfolios. And it's a good time to remind them why they are diversified and why they invest in something just besides stocks and bonds. Also on the alternative side is REITs. Real estate has performed very, very, very well this year. A lot of it due to lower interest rates. REITs typically have a lot of debt. Low rates are definitely a tailwind for them. And depending on what REIT products you use, you probably have seen double-digit performance pretty much across the board, and some extraordinary performance in specialized REITs, I would say, wouldn't be out of the question. So that leaves us to stocks. Right now, the Dow's at about 26,800. S&P's just under 3,000 at 2965. We've kind of moved between gains and losses through the month of August and early September. But I think the market is taking cues from a few things. Number one is the trade situation with China. I wouldn't be holding my breath that we get anything signed with the People's Republic, but we may get a respite in the trade war. Secondarily is the U.S. economy. The U.S. economy is sending a little bit of mixed signals. Manufacturing appears to be a little bit weaker and susceptible to the trade turbulence that we've had, whereas the consumer continues pounding the table, as I've said in those aforementioned retail numbers, especially the likes of Walmart, Dollar General, Target, Amazon. They've all had good numbers. It looks like the real sick man of Europe, as they would say before the First World War, is the U.S. mall. Malls are kind of going the way of, I would say, the big gas guzzler 6-seat Cadillac sedan. You're not going to be seeing many of those. The ones you do see will have lots of chrome and hopefully they make it. But mall traffic is definitely dying. Utilities seem to have peaked probably just a week ago. Most of the utilities that we have are well off their highs by about 6 or 7%, but that's coming off of, say, a 50 to 60% run up in the last year, especially with water utilities. And stocks appear to be rotating, with rates going up the last week. Financials have had a firm bounce. They like that. They like higher rates. Energy has been really the laggard in the different sector models that we run. Technology still is the lead dog. And the one thing not to fall asleep on and to talk to clients about is healthcare. Healthcare is the one industry that can really be thrown about due to the U.S. political situation. Historically, the fourth year of a presidential term cycle is the worst for stocks. That's going to be next year. Right now, the majority of recession indicators think 2021 would be the year. Historically, when you get an inversion in the interest rates like we had of the 2-year and 10-year, usually somewhere between, say, 8 to 22 months later, you get a recession. So that's all pointing to probably more volatility ahead for each one of us and our books. So it's more important than ever to stay diversified. Take profits when you have them. There's been some stocks that have had extraordinary run-ups. Microsoft comes to mind and some others in the tech space. But remember this, pigs get fat, but hogs get slaughtered. Until next time.